please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. The stock that's surging now is IndiGo, Interglobe Aviation. Just pull out the intraday chart of the stock. Now, there could be two reasons why you're seeing this kind of move on the stock. One, of course, is that you've seen once again crude oil prices go down almost back to 75. That could be one. And the other, of course, today's Wednesday, so there's going to be that cabinet meet. We've been talking about perhaps the inclusion of ATF or aviation turbine fuel in GST regime. That is something which, of course, if it happens, will be a big move. So perhaps that could be something where some bets are being taken at this point in time. But just keep an eye on some of these aviation stocks right now. Interglobe Aviation up about 2.5%.
Oh, absolutely. We had discussed this the last time when our colleague broke the story about the possibility. It's a big political move, right? So we don't know if it'll come through, but 5,000 crores of input tax credit is what the industry will see as a whole. So there's a big relief that could come through if ATF is under GST. But let's do one thing. Let's talk a little bit about Phoenix Mills now. That's the stock on our radar. Shishir Shrivastava, the joint MD of Phoenix Mills, is with us. They have acquired an under-construction mall in Lucknow. So let's find out more about that, how they will develop this asset, etc. Shishir, hi, good morning, and thanks for joining us on CNBC TV18. Tell us a little bit about these assets that you've acquired. What will be the funds required to develop this asset? What kind of annual rentals are you looking at?
Good morning. We have acquired a partly constructed mall, which was auctioned by the Lucknow Development Authority a couple of weeks ago. And, as you know, we already have an existing mall of about 330,000 square feet in Lucknow. This new acquisition is about 20 kilometers away from our existing mall. It's in the heart of, the action area in Lucknow at Gomti Nagar. This is a freehold land acquisition of about 13.5 acres, and the RCC construction is about 90% complete. We look at this mall upon completion to be the dominant district consumption center, which not only caters to the currently underserved market of Lucknow, but also other neighboring cities such as Kanpur, Rai Bareli, amongst others. We expect, the attraction for us here was that the city itself is hugely underserved. So Lucknow has been, in our opinion, a tier 1 opportunity. And with this acquisition, we are quite confident that we will cater to that underserved market. The other attraction for us was the fact that this mall is 90% complete. The design specs meet our criteria for our Phoenix market cities. And we believe that we should be able to take this mall to operation in less than 24 months.
Shishir, good morning. So what kind of revenues do you think it will generate for you? And in terms of numbers, how much will it add?
Well, for us, our rental income is a function of consumption, and the trends that we've seen in our existing mall are very, very promising. We've seen, a consumption growth in our existing mall from the previous year of close to about 15%, and that continues to grow in the mid to high teens year on year. This gives us, the confidence that this mall has the potential of upon stabilization of giving us rentals in excess of 110 to 120 crore. But that is upon completion and maybe a year and a half or two of stabilization.
Shishir, yeah, I do have some roots from that city, and I know that area is really up and coming. And yes, it's an underserved market, the few visits that I make to Lucknow. But, here's the question. You are adding a lot of retail capacity. How would the rentals that you just shared with us compare with some of the more established markets? And as we go forward this year, what's the strategy going to be? The mix between tier 1 and some of these micro tier 2, tier 3 markets that you're now targeting. What should we expect from the the commercial retail portfolio this year?
So, About a year and a half ago, we had announced our plans of doubling our retail portfolio from the current 6 million to reach a retail leasable area of about 12 million square feet. And over the last year, with the completion of our acquisitions at Pune for a second Phoenix market city, at Bangalore and Hebbal for a second Phoenix market city in that in a different micro market, and with Lucknow, and with the expansion potential that exists in our current operating malls, we are very, very close. We have visibility of hitting that number of about 12 million square feet of retail leasable area by 2021, 2022. So we're well on our way to accomplishing our goals there. Retail is clearly a focus area for us. In the last year, as I mentioned, for us, our rental income is a function of the consumption. In the last year, we've seen close to $1 billion of consumption across our retail portfolio, and our rental income has been about 14% of that. We would like to believe that going forward, we're going to see a similar trend, and with every square footage that we add to our retail portfolio, the numbers are going to increase similarly.
Okay, just one.
In comparison to our other malls.
Sorry, just one final question before we let you go, because we don't have much time, so I'm going to try and squeeze this in. You've increased your food, beverage and entertainment portfolio to 30% across your operational malls. Does that give you better margins? Because that's what we've seen generally in the past.
Well, you are referring to the total leasable area occupied by food and beverage and entertainment, including multiplex. Over the last few years, we have consciously made a shift from, what was previously these spaces occupied about 23–24%, and we've consciously made a shift to increase that. The reason behind that was, as I mentioned, we want to be the dominant consumption center in every city that we go to. And food and beverage and entertainment is clearly a great driver which attracts the correct profile of footfall into the mall, and that also increases spend in our centers, and therefore increasing our rentals.
Okay, Shishir, thanks a lot for your time today. Of course, all of us can relate to Phoenix Mills. Our office is next to the Phoenix Mills in Lower Parel. Thanks, Shishir. That's Phoenix Mills, of course. But the market is interesting. We had sort of a gap up instead of gap down. And after that, just a bit of a cool off. 10,858 is what we have. Ashwini Gujral, Mitesh Thakkar back with us. Ashwini, interesting. Instead of a gap down and then the market rallying, we had a gap up and now market cooling off a bit. Your thoughts?
See, this was expected. And that is why I say do not ever extrapolate a sideways market, because one day will be a rally and the next day will be a give back. Now we are precariously hanging around 10,850. Now what happens if we collapse to 10,750? Everybody who went long in the morning, yesterday afternoon gets trapped. They have to cut positions. And since morning, HDFC Bank, Bajaj Finance, Jubilant Food, all of these outperformers are coming off. And Bank of India and PSU banks, all those guys are going up. So I would think as soon as we break 10,850, you need to cut your long positions and get on the short side. We are in fact already short on Bank Nifty, because this is not really a breakout market, and trading between 10,850, 10,920 is a very precarious trade. So that way I think we could be in for a reversal once this IT pharma rally kind of peters out. So that's the view we are taking. NBFCs are performing fairly weakly today. So Bajaj Finance is a sell with a stop of 2275, target of 2200. India Bulls Housing is a sell with a stop of 1225, target of 1160. And Raymond you can try to buy with a stop of 990, target of 1035.
Okay, on this Bank Nifty short, Ashwini, what's the stop loss? Today's high?
today's high is a decent stop.
Okay. What about, all right, we have Mitesh and Sandeep Wagle also with us. So let's go to them. Mitesh, hi, morning. Apart from your stock ideas, you know, you had flagged off RBL Bank. It's risen quite a bit actually. It's up more than 3% right now at a new high. For long-term investors, is it still attractive at 560?
Well, I think very much. I think, you know, people who are looking at positional trading, who are investing for a few months, I think RBL Bank chart looks very, very promising. To me, I think the stock has been consolidating starting from April 17 in the range of about 580 to about 460. And while we haven't got yet seen the stock break above that 580, 585 zone, but the pattern suggests that eventually a breakout will happen. So after a year and a quarter kind of consolidation, we'll have a breakout, which could put targets in excess of around 700 over here. So very, very positive on RBL Bank, even from next few months kind of perspective. But in the short term as well, I think today some breakout above that 550 range, so still calls for a trading buy. That apart, I will continue to keep betting on pharma stocks. I have in fact 2 pharma stocks as on my buy list. Sun Pharma is a buy with a stop below 545 for targets of around 585, 590, and Torrent Pharma is a buy as well. Keep a stop below 1409 and look for 1470, 75 as your target.
By the way, another stock on the move today is Reddington, 11-12% higher, and Intercorp, that rally is still intact, 7% up. Let's get some more trading ideas going. Sandeep Wagle is with us. Sandeep, what are you working with this morning?
Good morning, Surabhi. I would go with a buy in a IndiGo, stop loss of 1220, target of 1269, and a buy in a Granules, stop loss 84, target 93.
Okay, so Sandeep, thanks a lot for those trading ideas. So let's see how the things move from here. Ashwini, just your thoughts as well on the aviation stocks, Jet and IndiGo?
See, they haven't really shown great amount of upside. So today I'm more interested in getting short on where people have been bullish for the last many days. I don't think IndiGo, etc. Are starting off any sort of fresh rallies. But this is just part of that short covering which is going through mid caps.
Okay, gentlemen, thanks a lot. Aviation stocks looking pretty good. In fact, at the high point of trade right now. But let's do one thing. Let's get talking about our hunting for value segment. My colleague Abhishek is here to present the case for a stock that has corrected more than 30% this year. So it's fallen quite a bit. But analysts are still bullish on the company despite the sector being under a lot of stress. Abhishek, over to you. Which stock are you talking about?
Well, Power Finance Corporation is the company under radar. The stock has fallen nearly 32% year to date and more than 44% from its 52-week high that it hit on 27th October 2017. The company had made a 52-week low on 24th May 2018, touching 71 rupees per share. What were the key reasons for such a huge fall in the stock price? The fact that PFC's restructured book swelled to actually 56,000 crore plus in Q3 FY18, which formed more than 21% of its book, actually, meant negative for them. The discoms have become cash-strapped, while aggressive bid projects have become financially unviable for power companies, and their ability to repay debt actually reduced. So the company has been seeing a decline on the yields owing to the stress in the portfolio. This led to a decline in the top-line growth, that is the net interest margin, and spreads have been declining every quarter for the last 8 to 10 quarters. But what can turn around is that government is focused on turning around the stressed assets in the power sector under the Parivartan scheme, which is being done in a JV with PFC, REC and other lenders at the helm. Now, Parivartan stands for Power Assets, Warehousing and Revitalization. The AMC, this will be under an AMC. The AMC firm will take over cases with a capacity of about 40,000 megawatt, and they will seek a 4 to 5% equity from NIF, which is the National Investment and Infra Fund. Worst of asset quality woes are behind for PFC, at it had reached 9.6% on its gross NPA, and they have been able to maintain their loan growth in double digits for last 2 quarters, that is at 10% and 13.5%. The management guidance for loan growth ahead for FY19 is at 10 to 15%. There was a huge decline in the restructured book by 57.4% quarter on quarter to about 24,000 crores. So that was a decline of more than 32,000 crore on a sequential basis. The management expects that of this 24,000 crores, 12,000 crore will move into the standard category, while they can be an an upgrade of 4,600 crore of NPA to restructure book. So what this will mean is that the overall provision reversal for the company will be at 830 crore in FY19, aiding healthy growth in the earnings momentum for the company in FY19. Analysts are maintaining the bullish on the stock, with ICICI Securities having a target price of rupees 200. They said that the valuations are cheap for a good dividend payout company and a steady ROE of 17 to 18% that can be seen on PFC. Axis Cap has a buy recommendation with a target price of 95. They say that the stressed assets in the private sector remain sizable and resolution of NPA cases is the next trigger for the company. Edelweiss also has a target price of 171 with a buy recommendation on the stock. You look at the peer comparison, PFC is trading cheaper than its next peer, that is REC, at just 0.5 times to book value. Now, the standard disclaimer, this is not a stock recommendation.
Sure. All right, Abhishek, that's a very important disclaimer. This is just research and data points that have been put together by Abhishek. But let's take the conversation forward. We have Mr. SP Tulsian of sptulsian.com joining in on this. Sir, your thoughts? I mean, there is a lot of hope building up that the worst of the asset quality issues are behind, a company like PFC. And if this bad bank of stress power assets comes in, then that perhaps deals with the problem even better. What would you recommend on the stock?
See, so to be taking the kind of the detailed analysis which Abhishek has made, I agree that, you see the end of the woes for the company, because if I just quickly go through the points which Abhishek has not covered, or maybe just to add in this, actually largely if you see the Q4 disappointment or maybe FY disappointment, where the NIM has fallen by 35 basis points for Q4 and maybe by about 70 basis points for FY18, has largely happened because of the interest reversal and 6 projects, having the exposure of 12,000 crore having booked as stress assets. Now, if I really take a call going forward, I agree that the major problems seem to be over. If I just add 2 or 3 data points in this, that 82% of the loan book which the company has been given to the government companies, and they are all seen to be standard. Of the remaining 18%, 7% are again to the high quality industrial houses or the groups which are not seen to be having any kind of woes or any kind of problem. That makes 89%. Now, out of 11%, about 70%, 71% of that of 11%, 71% are stress assets. That means 1% are stress assets. That means you have a problem only on about maybe which has been booked, and again only on the 3%, which we may see the problems going forward. But again, if you really take a call, the reversal of because of this Parivartan scheme, because of the major provisions seen having booked, we have already seen the hit on the NIMs and all that. In spite of that, the company has been able to post the good numbers. I agree that GNPA, gross non-performing assets of 9.57% is seen to be quite high, but the situation going forward is seen to be quite healthy. If I just take a comparative valuation also with REC Limited, which is a comparable peer on all the parameters, whether you take on the earnings, whether you take on the top line, whether you take on NIM, whether you take in terms of market capitalization, PFC is ruling at a price to book. I'm taking the historic valuations. I'm not taking for the FY19. I'm only taking as of FY18. PFC is ruling at a price to book of 0.55, while REC Limited is ruling at a price to book of 0.65. Now, if you really see, the dividend payout has been quite healthy. About 42-43% has been the dividend payout of 23 rupees plus EPS. For PFC, about 8.4, about 7.7 or closer to about 8 rupees has been paid as dividend, which translates into dividend payout of 42%. So I think taking the call, if you really, this buying call or maybe positive views only for the investors, those who have a little longer horizon, because probably the kind of interest which we have been seeing evoking now in the stress power assets, more especially in the thermal, where the cycle is very long for creation of those assets, are seen coming back. And I am quite hopeful that things will be seen in place once this process starts, and I don't think that major hits is going to be taken, and even maybe some of these stress assets will be moving back into the stress standard assets, which Abhishek has also stated and estimated to be at about 50%. So taking all this into consideration, the investor, those who have a longer horizon, horizon of maybe 6 to 12 months, I think this is the rock bottom. I don't see much of the fall going forward, maybe from here. As I said, because the REC is ruling at a valuation of 116 with a book value, current book value of 184, while PFC is ruling at a price of 84 with current book value of 150, is definitely giving safety over the comparable peers also, and holds good upside potential going forward.
So just one final question then, I mean, I take your point entirely, but do you think that there are better opportunities in the power space compared to REC and PFC? Because these are stocks, if you map 2, 3-year or even 4-year charts, they've given no returns to investors. So do you think there are better opportunities in this space?
See, Sonia, then I don't think that from a power financiers point of view, you can take any call on any of the stocks, because then you have the hybrid lenders, which we see more in case of some of the private sector bank and majority of the public sector banks. But yes, if I just take a call, then probably because power is a very broad spectrum. You have the power generator, you have the power financiers, you have the power distribution companies. And if you want to take a call, then probably PTC India, along, because even the PTC India subsidiary PTC Financial Services all seem to have facing this similar problem. But I don't think that any other stocks really seem to be having such a comfort what we see now in case of PFC, because as I said, that PFC again looks better in terms of over REC as well. And in fact, when I think that the climax or the worst performance for the companies were seen for FY17, and at that time also market was quite apprehensive that company may not be able to distribute the dividend. I'm not going and playing on the dividend yield theme, but even if I presume that if you have a 40% what you call payout ratio, and even if you have some kind of dip in the EPS, the dividend yield is also giving you a yield of maybe about 6-7% on the expected FY19 earnings. So taking all this into consideration, I don't think that you have so much comfort available on the related power sector in the different verticals, whether as a financiers or as a generator or as a distributor, what we have been seeing more in case of PFC and REC. But again, between both the two, I think PFC is seen more a preferred bet compared looking to the valuations.
All right, Ms. Tulsian, thanks for stopping by. By the way, the market has lost some of its mojo in the last 10-15 minutes. In fact, it is now just getting into red terrain, and stocks like heavyweights like HDFC, HUL, L&T are actually dragging its feet right now.
Yeah, Reliance as well, Sonia. But, one thing which really stands out is, as we discussed in the morning as well, the leader for this market now is State Bank of India. I tell you something that I don't know. I mean, there's something's up here. I mean, maybe some kind of program from the government or something. The way PSU banks are rallying, and yesterday it saw 450 crores of delivery buying, and today minor dip and immediately bought into 2% higher now on State Bank of India. This really could be your stock of the day for today, because others are cooling off a bit. But let's see, the boundaries are well defined now, days high and days low. Good reference points. Okay, so let's do one thing. Let's take a break, and that dreaded three-letter word, or 3 words, additional surveillance measures, ASM. That's something we're going to demystify today. We have 2 guests joining us on the other side, so do stay tuned in. The SEBI watch list will be tracked. We will do that with Rajnikant Patel, the former MD and CEO of BSE, and Deena Mehta, the MD Asit C Mehta Investments, after a short break.